Well, I think anytime you're trying to predict one particular meeting versus another, you know, it's a bit. My point was less about like literally March and more the general dynamic about saying, look, is there an urgency to cut interest rates at this point? And I think, and from what I see in the macroeconomic data, I don't necessarily see that. And I, have people, often people get really focused on the context and the trend and the commentary and stuff like that. But if you take a step back and you look at what's going on with the U.S. economy in aggregate, we basically have an economy that is, has been growing at or above potential for 6 quarters, unemployment at secular lows, inflation that has moved back to roughly the higher end, let's say, of the mandate, and following a period of inflation that it was relatively elevated, and you sort of look at that combination of things, I should say, and also an environment where asset prices have gone up, 10 to 20%, depending on exactly how you want to take a look at it over the last 3 months, and are at highs. If I were to just tell you that macroeconomic set of conditions and place you in any, developed world economy, what would be your expectation for the future path of monetary policy? It wouldn't be 150 basis points of cuts happening in relatively rapid succession, right? The macroeconomic conditions don't align with that set of dynamics, and I think it really centers around. So that's the core point. When you look at that, it's not obvious to me. Like in many ways, if you look at it from the Fed's perspective, they're accomplishing their mandate at the current level of interest rates. Why do anything in order to upset that circumstance, either to challenge inflation, particularly to challenge inflation on the upside or overheat the economy by cutting? And so you look at that set of circumstances, and I don't see necessarily the fundamental rationale for delivering anything close to what's going on. And the last thing I'd say is, I'm sure we're going to talk about real rates, and people are going to make the case that, mechanically, if inflation falls and interest rates stay the same, that there's a tightening of real interest rates. And that is just not, like, that is in a theoretical sense true, but not in a practical sense true. The fact that wage growth has remained elevated and inflation rates have come down has given the consumer more spending power, not less spending power. It is a easing, not a tightening, and it's an important reason why we have strength out of consumer demand. And so to use that as a reason to cut interest rates when we're seeing the exact opposite response from the U.S. consumer is highly indicative of the fact that it's a theoretical point, not a real point based in the fundamentals of the data. And so that's, so even that case of the real interest rate tightening point, I just don't find it compelling.